Jerome Powell is trying to communicate and steer this economy. Hey, I wish him the best. We can make money either way. We need to be nimble, but I think it's to your point. They hate uncertainty, and now you got a little bit more certainty to carry you through the next several months, which is why I think everything rallied.
Yeah, and bring up a good point there, right? Because certainty is important, and I think that 75 basis point, being off the table, obviously, right? So you want certainty in the market. I really, talked about that issue in all week, right? And why that's so important. With that said, we know where the Fed has to go, right? And when they're saying that's off the table, I mean, you know where you have to be. You really do. You know where we all know, right? You got to get it up to 3%, and you could do it now, or it could take 12 months. But what they're doing right now is playing that hope strategy, right? Okay, let's see what happens, and hopefully it's not too bad, and we'll see, and inflation moderates, and I get that. But when I look at the bigger picture, I'm a person that's, hey, you know what? We all know where it has to go. Raise aggressively, because I also said that you should be raising aggressively. We knew who they were. There's a 100% chance they were going to do exactly what they did, right? So, but when I take a step back, okay, what's important is you should be raising aggressively right now, because you could always take it back. Not that that's a great thing when you take it back and there are market implications and stuff like that, but you can take it back, because I hate when people look at a scenario and it's like, but for every decision you make, there's consequences. Even if you make, hey, this is the right decision, but still there's going to be consequences on the other side. So there's nothing perfect where if you do this, everything's going to be great. But I can tell you, if you look back, and I went back in the past and how did the Fed handle situations like this? So you're looking at the tech bubble. So it blew up in March 2000. That month, the Fed raised rates by 25 basis points, right? That month. And then in May, when the market was absolutely crashing, we were in the heat of this, Daniel, they raised again by 50 basis points, right? But they were wrong. They were dead wrong. So that's okay.
Because of course, May of 2000.
In March of 2000.
Okay, gotcha.
So this is the tech bubble, gotcha. Right? So of course, you see in 2001, they're like, holy shit, this is really, really bad. And they cut rates dramatically from 6.5% they were back then to 1.75%. And by 2002, we came down to 1.25%. And in 2002, that's when we kind of bottomed and we took off. In 2006, pre-credit crisis, and I should say pre-credit crisis, it wasn't really pre-credit crisis because the writing was on the wall, right? We saw several hedge funds blow up, Bear Stearns blow up. We saw mortgage companies file for bankruptcy. We knew in 2006, holy shit, man, something's going on right now. We didn't know to the extent, obviously, that, we're leveraging subprime loans, through the fucking roof where...
Didn't know how bad it was.
We didn't know how bad it was with AIG and stuff like that, 2008. But we saw the writing on the wall. Well, holy shit, like it's not often where hedge funds go bankrupt and big companies, mortgage companies go bankrupt, right? So we saw it. This is 2006. So the foundation was cracking, and the Fed increased rates from 4.5% to 5.25% in 2006. Right? So what happened? Holy shit, we were wrong, right? So rates were pretty high until September 2007. They were still high. Through September 2007, started aggressively cutting through 2008, which we all know what happened. They brought them down significantly to effectively, zero. And in 2017, we started raising rates again. I thought it was a smart move because we're seeing very strong growth, low unemployment, and zero is not normal, right? So we had to get up there, but we finished the year 1.5% after several rate hikes. And in 2018, the Fed just said, you know what? Hey, we got to take this back the rate and cut rates. And in 2018, the reason why wasn't from some dramatic event or craziness. It was a fearing of a global slowdown due to trade wars, right? So which was ridiculous. So we look at 2018, the Fed tightening, and then also in 2019 they started cutting it. I didn't think in 2019 they should have cut. They didn't really need to cut, right? Yeah. When we were at I think we got up to 2.5%, right? So we got up to 2.5% by 2019. All of a sudden they started cutting again, fearing the global slowdown. All the shit, there was a lot of talk. We still had strong. It was still okay, but anyway, we brought them all the way back down. My point is this. If you aggressively raise rates and you're wrong, you can always take it back. And like I said, it's not like, you take it back, but it's something, that's what you have. That's what you could control. The Fed could control that. When a reverse happens, when you're not raising rates during booming economic times, when all asset prices surge to record highs, which we saw last year, and trillions inject to the market, then you have today's environment where stocks are crashing, inflation's surging, and the Fed's forced to raise rates, which backs them into the corner. So, under that first scenario, the Fed controls the outcome. So if they're raising rates aggressively and they're wrong, they control the outcome, Daniel, right? So they control it. In today's scenario, the Fed has no control. They don't control the environment. The market is controlling the Fed. That's a major, major difference what's going on. The Fed is acting like this because of the market, where the Fed could be like, okay, here's what we could do. Now it's like you're so behind the curve. So for me, when I see a rally like this, because you say you're not going to aggressively raise rates, I wish you aggressively raise them, because what's going to happen, I think, over the next 2 weeks is you're going to see a sell-off. You're going to see the markets pull back because they're going to realize all this uncertainty. Holy shit, we got to raise rates. The war's still going on. Oil prices, inflation still happening. Ag prices, all this shit. And yet, if they aggressively raise, I think you would have saw the opposite happen. You would have saw the market crash and the Dow go down like 1,000 points. And then I think over the next couple of weeks, you would have saw it gradually go up, because we're getting closer to that point.
Right.
Right. And the Fed is having more control now. And that's what it's crazy to sound where the Fed has control. I'm just saying the Fed can control the outcome, which they're used to. Right now, the Fed can't do anything. It's handcuffed, right? They're handcuffed. They're like, holy shit. That's why they're not aggressive, because they're praying and hoping that something happens. That something is that inflation comes down. So I didn't mean to take up that much time with that, but yeah, it's important for you to understand, like, look, this didn't solve any problems.
Right, yeah.
We didn't solve any problems. We didn't come out and say, holy shit, yeah, it's not that the Fed could be there and the punch bowl. It's everything, all the problems that they still exist today, except, hey, what we're not going to do is aggressively, which I think is a negative. I think it's a negative if you're stretching out how long it's going to take for us to get to 3%, 2.75%, whatever. Why stretch it out so much? Why not just do it and get it there? Or, again, not by, they don't want to raise by 2, but just, I think you get a little bit more aggressive than what they did, but again, I don't think it solved any problem. So we'll see how the market reacts after this, right? The initial knee-jerk reaction, obviously when you see a move like that, there's tons of shorts.
Right.
And when you see the market moving like that, these algorithms like, holy shit, boom, right away, right? So we got to cover these shorts right away, and we'll, put them back in later on. But you saw a lot of short covering taking place, but it's going to be interesting to see. It's just going to be even more volatile over the weeks ahead, I think.
I like that. I like the transition here, because I want to talk about what do we think the odds of the future events are happening. Not that we have a crystal ball, of course. Allow me to put on my political consulting hat. What do you want? I think what you're saying, Frank, is yes, the Fed's not controlling the market in a sense, but you want them to be in a position of strength so they can control the narrative. Mm-hmm. And that's what Powell's trying to do. He's out there with a microphone telling people, and from that
that's why it's not a big deal, like what you said, right? This is the rate hike with this 50 basis point hike, first one since 2000.
Yeah,
we knew it was coming, right? So the Fed's controlling that, right? The Fed's, it's a great headline and it's awesome. And yeah, it surprised me too. I was surprised at that, but it's not a big deal, right? Because we knew it was coming. That's what the Fed's used to doing, just being able to predict and control.
And to answer your question on why they're not doing that, because I believe you, if they would have surprised the market, if Powell said, 75 basis points is on the hike, even a percent is on the hike, is on the table, excuse me. Yeah, Dow does the exact opposite. So the cynical in me, I guess, or the pessimist in me, they look at stock prices. No, we got to get, in that sense, people, you really want to think about, hey, stocks only go up, prices are good, wealth effect and all that kind of thing. They pay attention to stock prices. They care about their reputation. They care about what they're doing. And I'm not saying that's bad. I have to give him credit.
Organization.
He's at least halfway being consistent in the sense that he's admitting, hey, I'm trying to be communicative. I'm trying to explain to you guys what I'm doing. So to that point, I got to give him some credit.
And if you believe what you just said is exactly right, Daniel. So if you
stop right there. Next topic.
That's it. Let's go. And I'll see you guys tomorrow. Take care. Daniel was right. But just to the point of how the Fed looks at the market, I mean, you just look at 2019. I mean, why did the Fed start cutting rates in 2019?
Because we had a hell of a sell-off when I was at home celebrating Christmas and you were working.
Yeah, but it was because of trade wars that didn't exist, right? China, beating the drum, saying, with Trump and, talking a big game, even though they can't do anything, right? We buy their goods. We could buy them from any place. It would be more expensive to buy them other places, but as long as we have the power, we're buying your goods that you produce. China will always need us forever. So they are not in the driver's seat. Our politicians made them in the driver's seat, and I know that a lot of these contracts and everything, and maybe Trump handled it the wrong way, just saying with tariffs and whatever it is. But you look at 2019, we still had strong GDP. We just had a lot of this when you see the media, trade wars, and oh my god, and there's going to be no more globalization. All the bullshit. Think about and that was one of the things that again, you get things wrong, you get things right. But I wrote a report and I felt like it was controversial and saying this is 100% smokescreen bullshit. All right, there's no trade war. It's not going to be a trade war. Buy the freaking dip here. The Fed's there, low interest rates, right? They're lowering, and look at trade wasn't none of that shit, right? If you go back,
they were good buying opportunities.
If you go back to 2019, I bet there's about 50 million plus stories you can look on Google. Just Google it and it'll come up with like 100 million freaking stories on it of everyone, the media going crazy, no globalization, all of this bullshit. When, again, you're supposed to say a lot of shit, which China did in the US shit, but underneath, nothing really happened. China was just like, okay, here, whatever they give each other under the table, a special, whatever it is. But nothing really happened for that. So when I look at 2019, it's, hey, the market's crashing. Holy shit. But it was crashing for reasons that really didn't exist. It wasn't like we're seeing today where, look, inflation, right? That's a data point. Inflation, right? We didn't see like China stop trading with us, right? We just assumed that was going to happen. I mean, COVID, lockdowns. Okay, that's a data point. Holy shit, we need to do something. Like 2019 was a data point. You just looked at the market and said, okay, well, let's start cutting again. And when you did, the market came up, everybody applauded it. And then who knows what would happen if we didn't have COVID in 2020. But that's just to your point. I didn't mean to cut you off.
No, you're good.
If you look at 2019, it's a clear example of how the Fed's looking at the market and, just reacting instead of doing things where, holy shit, this is a major problem right now. We need to handle it.
Exactly. And when we're looking at the market, and so what they've done is done. So now we got a couple of more Fed meetings in place over the couple months that are going to be bullish in general for that. Well, Frank, this new normal, what do we think? Not, like I said, not that we're predicting, but because of actions they're taking right now, where are we at? Well, we still have COVID issues. We still have supply chain issues. So looking forward, what do we want to be positioned to as this plays out? And again, it's not that we're telling you what the future holds. We're simply saying, hey, the odds are pointing to higher inflation year over year at a constant level. Because as we've talked about in the past, once you get to that year over year mark, it may not go down a lot, but it looks a heck of a lot better when you're comparing to high levels last year to high levels this year.